Imagine a fund that lets you collect income just for holding it, week after week. Sounds good, right? That's exactly what Roundhill is aiming for with their weekly pay lineup of single stock ETFs. And to be honest, the results so far have been pretty impressive. Let's take a closer look. The Roundhill Weekly Pay ETF suite brings a bold, first of its kind approach to income investing, designed for those who want consistent cash flow with a twist of leveraged single stock exposure. Here's what makes these funds stand out. At the core, these ETFs aim to do two things. One is to provide weekly income. Investors receive weekly cash distributions, giving them a steady flow of income rather than waiting month to month or quarterly. And two, amplify stock returns. Each ETF targets 120% of the weekly price return of a specific stock, before fees and expenses. That means if the underlying stock, like Nvidia or Coinbase, goes up 5% in a week, the fund seeks to return 6% in that same week. These ETFs combine direct stock exposure with total return swap agreements to magnify performance. A small portion, typically 10 to 15%, is invested directly in the underlying stock. The bulk of the exposure, usually 100 to 110%, comes through a total return swap with a financial counterparty. The swap is structured to deliver 1.2 times the weekly return of the underlying stock. The result? Weekly distributions sourced from capital gains if the underlying stock rises, and strategic derivatives exposure. Most ETFs pay monthly or quarterly, but Roundhill recognized a demand for more frequent payouts, especially among income-seeking investors who want to get paid to wait. These ETFs are meant to mimic the feel of a paycheck or a weekly rent check. This isn't your average passive index ETF. If the stock drops 5%, the ETF is targeting a negative 6% return that week. Volatility is baked in. You're amplifying gains and losses. And because distributions are based on returns, not stable option income, payouts can fluctuate or even be paused during prolonged drawdowns. These ETFs are for active-minded income investors who understand single stock volatility, want frequent income opportunities, and are okay with taking on extra risk for higher potential reward. They're not ideal for conservative investors or those expecting smooth, predictable income. Before you go rushing into any of these weekly pay ETFs, there are a few critical things you need to understand. These funds are unique, yes, but they're not for everyone. And I want to make sure you walk into this with your eyes open. First off, always read the prospectus. That's not just legal talk, it's where the fund lays out exactly how it works, the risks, the fees, and what kind of investor it's built for. Roundhill is very clear, these weekly pay ETFs are not meant for passive investors. If you're not planning to actively monitor your investment, or if you don't fully understand how swaps, leverage, or weekly compounding work, these might not be for you. They even say it directly. If you don't understand what the fund is doing, or don't plan to actively manage your investment, you should not invest. The weekly pay ETFs are targeting 1.2 times the weekly return of stocks like Tesla, Coinbase, Palantir, Amazon, Nvidia, Hood, Apple, Netflix, Meta, and Berkshire Hathaway. That means the losses can also be amplified. If the stock drops big in a single week, so can your investment. Let me put this into perspective. If the underlying stock drops 83.33% in one calendar week, the fund could theoretically lose 100% of your investment in that same week. To be fair, a drop of 83.33% in a single week is extremely rare, but it's not outside the realm of possibility. This is a highly concentrated, high-risk fund built for precision timing. Even though the fund might track a stock like Coinbase or Tesla, owning the ETF is not the same as owning that stock. These ETFs use total return swaps, not direct stock holdings in full. You're investing in a derivative strategy, not the actual company. These funds use swap agreements to achieve their exposure, which introduces counterparty risk, credit risk, valuation risk, and liquidity risk. If something goes wrong in the structure, or if market liquidity dries up, the fund might not be able to unwind a position quickly or at a fair price. These funds are new, and that means they don't have a long track record. You don't know yet how they'll behave in different market conditions or during a major correction. Despite all the potential risks, I still find myself genuinely drawn to this fund. These funds, like COIW, PLTW, and HOOW, are actually doing what they said they would. The price performance has tracked or even outperformed expectations in some cases. That kind of early execution is rare in the high-yield ETF space, where many funds overpromise and underdeliver. These funds track names like Coinbase, Nvidia, Tesla, and Palantir, stocks that already have high investor interest and long-term potential. If you're bullish on the underlying companies, these ETFs let you lean into that conviction and get paid to do it. Now let's talk income, because that's the whole appeal here. Each of these weekly pay ETFs is currently yielding anywhere from 40% to 80% annually, depending on the fund and the week. But again, while 40 to 80% sounds amazing, and it is, it's only sustainable if the stock keeps moving. That's the trade-off. You're not just buying income, you're buying volatility and price movement. So when you put it all together, the high weekly yields, the enhanced exposure, and the innovative swap strategy, this might just be the perfect income opportunity for certain investors. But of course, like everything in investing, it's not about the headline number. It's about understanding the mechanics, the risks, and how it fits into your broader strategy. So what do you think about the Roundhill Weekly Pay ETFs? Are they a smart way to turn stock volatility into reliable income, or are they just another shiny product chasing attention? Let me know your thoughts in the comments. And as always, this is not financial advice. This video is for entertainment and educational purposes only. If you got any value from this breakdown, a like and subscribe goes a long way in supporting the channel. Thanks for watching.